Hi, and welcome to our series on Thursday Talk, where we have a focus topic. And this month we are talking about the low volatility factor. So, if you've seen the last two videos, let me quickly take you through. I showed you how low volatile stocks outperform high volatile stocks, whereas finance theory tells us the exact opposite. That the more risk you take, the more returns it should be, and that's why it's called an anomaly. But as we go along, I'll explain to you why it's not an anomaly. It actually makes a lot of sense. Why this thing works out. Then last week we saw what are the reasons why this so-called anomaly exists. One is that people buy highly volatile stocks which are in the news for the wrong reasons, sometimes for sometimes for the right reasons, but they're very volatile. And stocks which are highly volatile in the long run tend to underperform, and stocks which are less volatile tend to outperform. But people get attracted to the volatility of these stocks because they like to see quick gains, but those gains also quickly evaporate. Also, the same thing happens to professional investors, portfolio managers, where they want to take higher risk in the short run because their incentive structure is built in such a way that there is no major downside for them, but there is upside for them if their high risk strategy pays off in the short run. So that's a couple of the plausible reasons, why we think this exists. There could be many other theories that have been floated, but this is what we think are the main reasons, and academicians agree with us that this is why it does. Now, today, let me show you uh, where it works. Why and why are we saying this? Now, the we said that high risk, high return does not work uh, at the uh, at the stock level, which is correct. However, it does work at the asset class level, and let me show you how. So let's take the case of equities. Equities over the last 5 years have returned about 12.5% with a volatility of 22%. So you've seen more volatility there. Gold has returned about 9.3% with a volatility of approximately 19%. Bonds have returned about 8% with just a volatility of 2%. Of course, in the last 1 year, bonds would have suffered. So, once this data gets updated, we'll see that bonds are also less tax efficient. Bonds, FDs are less tax efficient. And FD rates are also fallen a lot in the last couple of years. So once we update the numbers for 2022, we'll see a change in those numbers. But you get the drift, right? That the more risk that you've taken, you've got higher returns, and you can see that in this graph where where on the y-axis is the standard deviation, and on the y-axis are returns, and on the x-axis is standard deviation. And it shows you that as you go higher up the risk curve, or the volatility measured by risk curve, uh, your asset class tends to outperform. However, this does not happen the same way in equities. So we took our universe of stocks and divided them into deciles, which is basically 10 portfolios, and ranked them from low volatility to high volatility. Stocks with stocks, and here you can see stocks which have the minimum volatility, or a portfolio of stocks which have a minimum volatility, have given a return of 13%. Stocks, as we keep going down, the volatility line, you can see there is one outlier here in the region, or in the D4, which is the fourth decile, where perhaps that outperformed by, but you will see some kind of thing. But you get the broad trend, and you can see that as you move along, the decile 9, 10, 8, 9, 10 all have underperformed the top decile, and that's the effect that you actually want to see. It stops, and this happens consistently. This happens consistently over time, not all the time, but over time, a big difference. Because there may be times when, as in the last couple of years, when suddenly high beta is outperforming, but then it quickly mean reverts, and the gains go away. So So, so that's our two slides for today. I want to leave you with this picture. I want to see this, uh, uh, see this picture, this one and the previous one, that uh, high risk, high return works at the asset class level. At the equities level, low risk, high return works. And we'll discuss more about this in the coming weeks. So with that, we come to the end of today's video. So the disclaimer, as always, that it's not investment advice, it's purely for education, and please consult an investment advisor before investing. And you can follow me on Twitter at Anish Daily at QEDCap. And if you have any more questions, just head over to qedcap.com. Just ping us or call us, and we're happy to have a conversation with you. And do like, subscribe, and follow our YouTube channel. So thank you, and see you again next week.